Hey everyone, Alex Slade from Trencher Mortgages. Going to do a quick video discussing prepayments on a mortgage and whether or not you should do them at higher interest rates, lower interest rates. Most people think that um, they want to put prepayments on their mortgage at a lower interest rate because it'll have more impact on the mortgage, when sometimes that's not actually the case, depending on what your interest rate is and where you are in the amortization or the time remaining in the lifespan of the mortgage. So with this, I'm just going to be going over how prepayments, first off, will even affect your mortgage, and what options you have to either prepay, increase your payment, how much you should pay down. So we'll jump right into it here. We are going to use some some software we have on our end as mortgage agents. So I will show you another free tool that you can utilize that I think does a good job as well. But for this purpose, we're going to use this one here. To start, we're just going to use $500,000 mortgage, interest rate at 5.54%, which is current on of what's on the market right now. You could get amortization 25 years. The initial mortgage payment, we'll calculate that, will be $3,063. I'm going to assume a monthly payment. And then this is where we're going to add in lump sum payments and over how many periods we're going to add those lump sum payments. So to start, we're going to utilize, so actually before I even do that, let's calculate how much interest you're going to pay over the lifetime of this loan, just as is right now. So we're going to generate the document. It's going to show us, if we go all the way down to the bottom, accumulated interest. So interest is this column here. Accumulated interest, 419,000. Okay. So total amount that you will have paid is 919,000. So your 500,000 principal, or the amount that you borrowed, plus the interest, equals 919,000. Okay, so if we close this now and we add in lump sum payment, let's imagine that you do a lump sum payment of $10,000. Initially, let's just see what this does. So we're going to calculate. It's going to bring, oh, my mistake, I have to add in, we're going to add it in the first period or the first year. It's going to bring down your amortization to 24 years. And let's calculate what that change in payment would be. So you see we're over 900, now we're into the 891,000 mark. So and also what I should show is this calculates the amount added to the first period of the first year, because it's more beneficial for you to add it, to pay down some principal at the beginning of the year as opposed to the end of the year, because the interest that's calculated that year on that interest rate is on the principal for the entire year. So if you pay the 10,000 at the end of the year, you would have still paid interest, the majority of the interest, the previous 11 months, let's just say. Whereas if you do it in the first month, then the principal is down, so you're going to pay less interest over the remaining 11 months. So anyways, you see here, the 10,000 is added there. So let's just assume, because you're not going to be able to do this every year, obviously, and 10,000 actually is quite a bit amount, but let's just assume you do it for 5 years. Let's see how this reduces your amortization. And remember, if you're not familiar, amortization is the amount of time it's going to take you from the first year to the last year to pay off your mortgage. Generally speaking, in Canada, we see amortizations of 25 or 30 years. You can get one for less, but it's harder to qualify for those mortgages. Okay, so we're going to see $10,000 for 5 years. Let's see how short that brings our amortization down to. Brings us down 5 years. So we're going to see here. So you can see at the beginning of every year, they add $10,000 to the total paid. Okay. Or you can see over here, you can see the 10,000 added. Okay. So interest paid over the entire amount. I think we were at just over 900, and we were at 890 something. Now we're at 812,000 interest over the 25 years. And in this case, it wouldn't even be 25 years. It would just be just about 20 years, 21 years. Okay, so now that we've seen that, let's see how this would have an effect on actually, before I even do that, let's change it up a little bit. And as opposed to doing a $10,000 prepayment per year, let's imagine that you're actually just going to increase your mortgage payment just by $100 per payment. So we're going to do $100, and we're going to have this added for the remainder of your mortgage. Let's see how much this changes the amortization amount from 25 to what? So we're going to calculate. It's going to bring you to 23 years, okay? So your new mortgage payment was regular $3,061 or $3,063. You're going to add $100 per payment. It's going to bring you down to 23 years, and the amount paid on a mortgage is $887. So just under that 900 mark, what we saw before. And so that's adding, let me go back to that actually. That's adding the $100 payment for the duration of the loan. You can see it go all the way to the 25th year. Okay. Now let's imagine you do $200. Let's see what that does for us. Brings you down another year. So there is the possibility of, as opposed to just putting principal prepayment of, let's say, $10,000, you can also just utilize extra payments on every payment, and that'll bring down your amortization as well. And remember, the entire purpose of doing any principal prepayments or adding any payment on top of your regular payment is to reduce the amount of time that you're going to be paying, and not only that, but reduce the amount of interest you pay over the lifespan of the loan. Okay, so with that shown, let's reset everything here. And let's take a look if your interest rate was 2.5%, because a lot of people during the pandemic from 2020 until 2022 were able to lock in some really low rates, even under 2.5, but let's just show 2.5 to be conservative. Calculate there. Your payment on this would be $2,239. First off, you see how much of a difference that is, about $700. And then let's see what the interest total would have been paid. So the other one at the 5.54 was about not 900, just over 900,000 paid for the entire loan amount. This one, 671,000. So huge difference, about 230,000 there, which is drastically different. Now let's do the same thing here. Let's say we did $10,000 prepayments. The first one, how much is this going to decrease your amortization? Only decreases by a year. This is almost the exact same. This is almost the exact same amount that we saw with the 5.54% interest rate. And also, I should have been showing this earlier, but this shows you represent savings of interest of $8,400. And you can see here. Let's take a look at the document. You can see we went down to 663,000, okay? Which is not too much, right? Because you're already paying a low amount of interest. Now let's say we do this for 5 years, okay? It's gonna save you $35,000 in interest. Bring you down to 21 years. Again, not very considerable. It's sort of a fallacy that people believe that you're gonna do more to your mortgage if you pay it down while the interest is low. It's actually just not the case. And then we're going to show here, we're just at about 660. Now we're down 636. So not really much savings there. Like it shows only about $35,000. Okay. And now let's see if we go 0 here and 0 here. We're going to add in payment increase of $100 for the duration of the loan. Let's see where it brings it out to. Only 23 years, 7 months. $10,000 savings. I don't think I need to go into the document again, just to show you there. And then let's do $250. Again, brings it down to 21 years. So there was actually a greater effect at the 5.54% interest rate of having the $10,000 nominally. I mean, the actual just dollar amount that you're saving. So over 5 years, yeah, you're saving $106,000. So what I would say from this, even just using this data, this is a $500,000 mortgage. Of course, it's going to change from mortgage to mortgage, but the principles relatively remain the same. Doesn't matter what what mortgage balance you have. This will change a little bit depending on where you are in your amortization. So if you're already 10 years into your payments or 1 year into your payments, this is going to have a different effect, which is why we use this calculator, because we can change the amortization and where you are in the mortgage payment. So let's just make sure that has the same effect. Yes, it does. Okay. With that said, I did say to you guys I was going to show you a good calculator that you can use for free as well. So if we go to Google, I'm going to type in Scotiabank mortgage calculator. Go here. They have a really good tool for calculating your mortgage and also the adding prepayments onto it. So let's do the same thing, 500,000, 25 years, 5.54. And then the only thing is with this one, you can only do annually, semi-annually, or once for how many prepayments you can do. But let's just do the once. It's going to bring it down to 24 years. So it calculates in real time, which is awesome. And then you can also create a personalized report. Okay, on that. And you will see here that it'll actually show you the 10,000 added right here and how much interest you paid over the lifetime of the loan, I believe. Yes, it shows here and the total payments made. So very similar to whatever other data shows, which is cool because it's also a free calculator and it shows really, really easy to use. And then you can also compare two mortgages here. So mortgage one, mortgage two, you can put 20, you can put 5.54 versus 2.5. What would the payment be on a monthly basis? And you can see that right there. View mortgage and comparison graph. It's going to show you everything here. So pretty cool calculator. I do like to use this from time to time when I don't want to go into the other calculator. If I just need a really quick once-off payment or annually payment, that'll help. Again, this also doesn't allow you to add. Oh, it does actually allow you to increase payment. You have to do it by a percentage though. And again, it's annually or once. So you have to really play with it there. Whereas ours has a little bit more customizable features there. There is something also to be said about having your frequency changed. So if you do monthly versus bi-weekly versus weekly, obviously you're going to have a different payment. Monthly, it's going to be 25 year amortization is going to take 25 years. Bi-weekly, it's going to reduce your amortization. So I'll quickly show that here. Let's show no prepayments, 0 payment, calculate. Okay, so this one won't actually show that, but if we go in this is where the Scotia one comes in handy. If we go 0 here, bi-weekly, so regular, you're going to do 25 years, change it to bi-weekly. It's going to bring you down to 21 years, 3 months. And go weekly, same thing there, okay? Which is really, really cool. So the Scotiabank calculator actually has quite a few good I would say features as well. It just has a little bit less customizable in terms of how many times you're going to make a prepayment, how much you're going to make a mortgage payment increase, and so on. So if you like this content, guys, I really appreciate it if you give a like, subscribe, and potentially even share with people you might know who are thinking about this. It sort of breaks the fallacy of, oh, I have a low interest rate, I should be putting the mortgage payment down now. You actually save more on a nominal basis when you have a higher interest. And there's something to be said about utilizing some of that prepayment, that $10,000, $5,000, $15,000, whatever it is, and potentially putting that into some sort of investment, whether that be investment on paying down higher interest debt or putting it in some sort of, stock, mutual fund, or even buying another rental property. So there's all things there. Any questions, leave a comment in the description or in the comment section below. And I will have the link to the Scotiabank calculator in the description below. Thanks, guys. Have a great day. Cheers.